Hello everyone, welcome back. In this video, we will discuss in detail the stage 1, which is the initiation of financial crisis. In the last video, I told you three reasons, maybe three factors which weigh in during the initiation of financial crisis. The first one was that the financial statements of financial institution decline, and the second one was asset price decline and increase in uncertainty was the third one. Now we'll dive much deeper into each of these problems. So the causes of the financial crisis may begin with first a mismanagement of financial innovation or liberalization. So usually what happens is, for any healthy market, there always has to have certain financial innovation and liberalization. 200 years back, the stock market looked very different, and today it looks very different. 200 years back, we had just slips for the stock market. Now you have uh, bitcoins, you have cryptocurrency. This is which is known as the financial innovation. So for any healthy market, financial market to develop, there has to have certain financial innovation and liberalization. The market should free up, they should become more cross border. So usually what happens during a financial crisis, there is an introduction, there will be an introduction of financial innovation. So there will be a new financial instrument. There might be a, for example, even cryptocurrency. So there is an introduction of financial innovation. For example, in 2008 crisis, there was something known as subprime mortgage backs. There were mortgage backed securities, MBS. There was something known as mortgage backed security. This was also a type of financial innovation. So there is usually an introduction of financial innovation, and then there is certain financial liberalization. So what happens in financial liberalization? There are two things you have to understand. First, in short run period, what happens? It will lead to a lending spree. So there is going to be a credit boom. There is going to be a credit boom in short run. And in long run, what happens is there is financial development. So what it means is, if there is financial liberalization, usually with financial liberalization in short run, we see that there happens credit boom, and over long period of time, eventually there is financial development because of liberalization. However, if this credit boom might become very unsustainable, this credit boom might be the cause of worry. So what happens in during a credit boom, if your lenders do not have expertise to manage risk properly? So say there is a credit boom. Now you have lenders who do not have expertise to manage risk properly. Then there are government safety nets in the market. So the government babysits the market. So when the government babysits the market, government says, oh, okay, you are just in the development process, I'll give you this much amount of subsidy, I'll give you these safety nets. So when the government babysits the market, what will happen in this scenario? In this scenario, this weakens the market discipline. Now the markets become reckless because they know that they have government safety nets. The government will bail you out, they'll pay you out. So This thing weakens market discipline. There is increased moral hazard. Incentives for banks, because now banks can take more risk because they are backed by the government. And lenders are essentially the banks. So this lender saver supply, and these lenders will supply to undisciplined banks. So this is a good question to ask. Why will a saver, if I am a person who is saving, why will I lend or supply my funds to an undisciplined banks? Because usually what happens is these undisciplined banks mean, the meaning of the undisciplined banks is these are risky banks. They take a lot of risk. They invest in a lot of risky assets and thereby increasing the chances of return. So that is why savers say, oh, I want a great return on my savings. So they just start supplying it to the undisciplined banks. So this is the reason. So there's government safety nets. The lenders do not have expertise to manage the risk properly. Then what will happen eventually, because of all these factors, losses on losses, amount value of loan falls. So there are losses and losses. There are huge losses, and the value of the loan eventually falls. So this value can also fall. For example, now this is, I told you last class, we had a balance sheet. Balance sheet is nothing but the position of asset and liability. So for banks, their assets are the loan they advance. Loan or advances are their assets. Because the borrowers are bad, because there is no market discipline, these loans, these advances start becoming bad. They start becoming ill. So this part of their balance sheet start deteriorating. The assets are the charges against the liability. Assets are something which secure the liability, right? So how am I going to pay back to my creditors if I don't have money in my own bank account? If I don't have land to sell and pay back to my creditors? So assets are important. And when these loans and advances, they become bad or ill, there are losses. And the value of the loans fall. And usually you'll see with these type of crises, what happens, there is something known as NPAs, which mount up. I'll give you just a brief gist. So banks have, you know that banks lend, right? So from the one end, banks accept deposit and they lend funds, right? These funds, I can segregate these funds into two categories known as standard assets, because I know these are the assets for the banks. They get return on loans in form of interest. So I can segregate them as standard assets and substandard assets. And then furthermore, in the substandard asset, there are substandard assets. These are the assets we call performing assets. And these are the assets we call non-performing assets. So in non-performing assets, you have substandard asset, then you get doubtful assets, and then eventually there are loss assets. And there are different criteria countrywide, country to country, how they segregate funds into performing asset or non-performing asset. So something can be, so if you are receiving the interest and the principal amount for 100 days, say I'm just giving you an example, for say 100 days or 90 days, then your asset is a performing asset. But however, say the 90 days passes right? 90 days passes, and the loan which was due, the interest which was due on that loan, you're not receiving anything. So that loan you will have to put into the category of a non-performing asset. It is a dormant loan now. Okay, and further there are classification. Let's not get into the detail of all this stuff. So this part becomes very high for the banks, the non-performing assets during the crisis. So eventually losses will mount up, the value of the loan will fall, and when the value is falling, right, the asset, and then you have liability. When the assets are falling, what this means is the net worth of bank is also falling. The network of banks fall. When the network of bank fall, we say that banks have less capital to lend now. So the institutions will cut back on their lending. So what was first started off as a credit boom, and because of this poor risk management skill of your lenders and these government safety nets which weakened the market discipline and which increased moral hazard, eventually you see the institutions cut back on their lending. And this when they cut back on the lending, this thing is known as deleveraging. So they are deleveraging. This usually happens when there is over lending in a market. Usually after a period of over lending, there is usually deleveraging by the market. And now you see there's deleveraging. Now you see the banks are cutting off their lendings. They are becoming unprofitable. So the lender savers, they now become cautious. They'll pull back their funds. So they start pulling out their funds. So when they pull out the funds, they even have few funds to lend. So loan to fund productive investment decreases. So you see, from when they are pulling out the funds, they are reducing their savings. They are reducing the investment. The investment is reducing. In a way, the consumption is also reducing. So overall, you can see the aggregate demand is also reducing. And then eventually it will lead to a credit freeze. And this will turn into a credit crash. So this is a nightmare. So you see, what started out as a boom, what started out as a boom, what started out as a boom, you can see it soon turned into a credit crash. So this is the first part, that there is mismanagement of the financial innovation and liberalization. The second part which I told you were the asset price boom and bust. So how does this unfold? I'll take this up in the next video. I'll also take up the increase in uncertainty, and we will be done with our stage 1 initiation of financial crisis.